So when we start talking about earnings per share, that's usually something that's somewhat complicated, but not. Here's the way I would look at it. The chapter is divided into, this portion of the chapter is divided into two parts, but I would divide it into three. Number one would be, the first part would be your basic earnings per share. Your second part would be your diluted earnings per share, but I will split the diluted earnings per share between options, rights, and warrants and convertible securities, because those are two different things. And also, also your convertible preferred stock. So I'll split that chapter between those three, because you'll kind of see the book just layers on each time. And I think that's the best way for you to understand it or to compare and contrast as you study, okay? So what's a basic earnings per share? Well, what is earnings per share? Earnings per share represents the earnings that's available to common share stockholders, okay? Not preferred. That's one of the main reasons, one of the second main reasons why we have a bunch of adjustments to make sure that earnings per share represents only what is available to common stockholders, all right? Now, the other part is to make sure that we have the appropriate amount of shares in there for the time period. What does that mean? If you buy some shares in June, when do you start reaping the benefits or what is the earliest you can start reaping the benefits of dividends? In June, right? Well, the same thing with the company. The earliest they can reap the benefits of the cash that they raise from you would be in June. So we have to make sure that we time weight those, or as we call it in the book, use a weighted average calculation to get there. That's one of the main things we have to do. So number one, making sure that we have the weighted average amount of shares that should be in there that are what you would call dilutive if it comes up later. And also making sure that we understand that, that if you should have anything that's applying to preferred share stockholders, we take that out. And only what is left is going to be for the common share stockholders, all right? So when we issue shares, if you look on page 1142 here, this little fundamental calculation is the same thing you use in principles of accounting or financial accounting. And that's basically your net income divided by your shares. In just a second, we're going to expand it just a little bit. We're going to start with the base. The very, very, very basic is net income divided by shares. All right. Now, right here on the issuance of shares, what I'll put there is time weighted, because that's where we will look and say, well, were shares outstanding from February through the end of the year, from September through the end of the year, or whatever it may be. And we'll see the same thing with treasury stock transactions. OK, but the first part that we want to understand is weighted average computations. Let's look at this small example here on the very bottom of page 1142 or at the top of page 1143. It kind of goes together. OK, what you're going to have is on January the 1st, you're going to issue 60 million shares. Oh, 60 million shares. And then on March the 1st, you're going to issue 12 million shares. Now, once again, as the company, when do you have, for how many months do you have the benefit of the cash received from me for the 60 million shares? All 12 months, the whole year. That's why we kind of don't say 12 divided by 12, because it's going to come back to 1, okay? But on the March the 1st issue of 12 million shares, how many months do you have the benefits of the cash from the $12 million share? For only 10 months, or from March to December. So that's why we have new shares, which is 12 million multiplied by 10 over 12. Does that make sense there? So for each time you add shares, you're going to do that. Likewise, as we see in a second, for treasury shares are going to be taken back as of that point in time. So this is the easiest way to do it. Whenever you see shares, make sure that you put them in the order they're received. And that goes for everything else. As we'll see when we talk about stock dividends and stock splits, if the stock split happens before the stock dividend, do it that way. You cannot get the right answer if you do it differently. I've tried it, and I tried it again last night just to see if it changed in this textbook, and it still hasn't changed, because that's just the order that it impacts. And that's why I say from each section is going to layer it on in the way that you should do it, or maybe in the way that you should think about it. Not that that's the only way, but if you follow the textbook, it's going to get you to your correct answer. All right. Now, let's look down at the next illustration, 19-7. We're going to take those same January and March 1st share issuances, okay? And every time you see something in red, that's going to be an addition. So now you have a 10% stock dividend. So what do? What is a 10% stock dividend?
They distributed 10% of their
shares that are already outstanding at that time. So, for instance, if you had, kind of going back to what we talked about last time, if you have 60 million shares on January the 1st, and then you have a $10 million share issue, you will end up with a total of how many shares? Keyword, with a total of how many shares? I hear it over here. 60 times 1.1 will give you 66. That's the total. Now, the additional shares issue would be how many, just thinking about the way you kind of see things on exams, or that's kind of out of sequence. The additional shares would be the 6 shares, okay? But we have to make sure that we can take into account every share that has been issued. So that's why, just don't make the mistake of adding 6, okay? Go ahead and do the multiplication that they have here, and I believe that that'll get you to your correct answer a little bit more consistently than saying, well, let me do this and subtract everything else, all right? So the stock dividend, as you see, is going to be applied to both the January and to the March. Now, why is that? You might want to take this note, because stock splits and stock dividends are effective as of the beginning of the year. Stock splits and stock dividends are effective as of the beginning of the year. So I don't care if it happened in January, on November the 37th. That's not a date, I'm sorry. November the 31st. That's not a date. November the 29th. I'm backing it up there. If it happened later in the year, that is the date that it happened, but it's effective as of the beginning of the year. So you have to go back and restate or recalculate everything that has happened. Does that make sense? So if you have a stock split, go back and calculate it. If the stock split comes before the stock dividend, please make sure you put it in that order, because your answer won't be correct. Now, why does that make sense? Let's just take 1 year's worth of financial statements. A stock split occurs on June the 17th. If you just take it as of June the 17th, it just won't look right to have an earnings per share based on a double amount after June 17th versus a single amount before that. That just doesn't make sense, does it? Now you start adding in last year and the year before, and you're really not going to see different comparisons, or you will see different comparisons, and that won't be right. So not only do you have to do it here, but you must also restate everything that you show on your balance sheet. If you look at any company that's had a stock split, everything will look like it is brand new. For instance, when Apple gets to the next high, it's going to be, if it's $166 per share, they're going to say new all-time high, $166 per share. Why is that? Because the split, it was effective as of the beginning of time. All right, it's just for what they're showing is that, it's going to be up to that point, but it's really effective as of the beginning of time, which means that you'll never see a time where, well, theoretically, in theory, you'll never see a time when Apple stock was $700, because that no longer exists after the split. Does that make sense to you? Okay, so make sure that the split occurs as of the beginning of the year, and if you're preparing multiple years, that it goes all the way through those multiple years, all right? Any questions about that? All right. A couple of theoretical things I want you to point out is in that paragraph in between. Think about the journal entry. That'll kind of help you to also understand that when you actually sell shares, you're going to debit the cash and credit the stockholders' equity. But on the other hand, with the stock split, it just creates the shares. It just creates new shares, but it does not touch the total assets. That's another reason to kind of highlight what we talked about last time, why there is no journal entry for a stock split. There's only a stock memo, because the total assets never change. All right. Now, if we flip the page, what happens if we have treasury stock? Just a quick review, what is the difference between treasury stock and restricted stock? Treasury stock buys back the common stock, okay? Restricted stock takes them off the books as if they had never been issued. So once the treasury share transaction happens, we have to take that into account as well, okay? And once again, if treasury stock transaction happens before the stock split, do it in that order. Whatever the order is, that's the order we do it. And so at the bottom here, we see something in red here, and that's on October the 1st, the bottom of page 1144. The treasury share transaction happened over the last 3 months of the year. So you see we subtract the 8 million shares, but why do we multiply by 3 over 12? Because it's for only that amount of time that the months have passed in terms of at the end of the year when the treasury transaction would have been effective. So whatever month is issued or whatever day is issued, if you go by days, depending on what it is, make sure you take that into account. Does all of that kind of make sense to you there? Any questions? All right, so far we've only dealt with the denominator. Now we're going to come to your point there, which is very important. But the way it kind of takes to make sure we do all of the denominator work first then do the adjustments to the numerator. Why do we adjust for preferred stock for dividends to preferred share stockholders?
Because preferred stock's not, you're trying to get something on common stock, you know.
Right. Earnings per share is a common share stockholders is a common share stockholders equity number, not for preferred. So I know this is going to sound kind of funny, but we're taking the net income and subtracting out the dividends. That is true. That never changes. But if you see a problem like this and it asks you, how do we pay our dividends? Remember, dividends are paid out of retained earnings. So don't let this fool you in terms of how questions can kind of come about. They may present this information and ask you, do we pay dividends out of retained earnings? And you're clearly looking at an adjustment to net income. Remember, all unused net income flows into retained earnings. So this is why it's kind of taking it out right now. Okay, so it's true that preferred dividends is subtracted from net income because we want to show you the net income only available for common share stockholders. But remember, all dividends are paid out of retained earnings, and we know that from the last chapter. So just kind of keep that in mind. As you see here, on January the 1st, we had some non-convertible preferred stock, and we are subtracting the dividends at that point in time. All right. Now, this applies if it's cumulative as well. If it's non-cumulative, we do not take out that portion. But if it's cumulative, which is what the very last paragraph on page 1145 is showing you, if it's cumulative, make sure you take that out. So if over the last 2 years you have cumulative preferred stock and you do not you do not actually pay it, then make sure that you take that into account. Otherwise, your answer or your computation will be incorrect. And for that matter, sometimes they'll ask you about a question. I've seen it on the CPA exam about cash flow per share. There is no such thing as cash flow per share, okay? Just earnings per share. So kind of keep that in mind. Those are things that I've kind of seen, or at least it was on mine. I'm pretty sure it's still out there, okay? So any questions on that part right there? That's the basic earnings per share computation.